The question routinely comes up of how a loan gets paid for. Ultimately, there are a couple of different options on how it can be paid for. One way is for the borrower to pay the closing costs in cash. Whether it's a purchase or a refinance, the borrower comes in, makes the down payment, and pays the closing costs by writing a check. Another way they can be paid is to add it to the loan balance. This is particularly common on refinance loans, where we add the closing cost to the loan balance and you come out with a larger loan. Another way to pay for them on refinances or purchases is to have the loan fees paid with a lender credit. We get money whenever we sell the loan. We can use that money to pay closing costs on a loan. A borrower can pay the closing costs with cash that they bring to closing. With a purchase transaction, we can have the seller pay the closing costs. Just understand that when the seller pays the closing costs, it's not free money. Typically, it means that if they pay $2,000 in closing costs, they're getting $2,000 more for the property, and it has to appraise for that amount. They then pay the closing costs, or they would take $2,000 less for the property and pay nothing in closing costs. It would be the same to the seller each way. The house still has to appraise for the higher purchase price, but that's another way to do it. For any given borrower, we're happy to sit down and talk to them about the various options that are available to them, and we can pick the optimum way for a given borrower or a given transaction, whether it's a purchase or a refinance transaction.